Hi everyone, this is Tim Melvin coming to you from down here in Central Florida, where it's been a very chilly day. Today only about 55 degrees. This is our third take on this video. We're trying to redo the video system because we had so many problems the other way we were doing it. But now I think we finally solved all the sound and video issues, so we'll just shoot through this real quick. So it's been a cold day. I bet you it wasn't even 40 degrees when the dog and I went out this morning, so resorted to my favorite warming up trick. Called my friends in New York and Maryland to ask how the weather there was there, if they were ready for the big snowstorm this weekend. And then of course checked in with my daughter in Chicago, where I can only imagine how much fun she must have had at 6:30 this morning walking her dog on that 11th floor dog walk with the wind whipping in off of the lake there in downtown Chicago. She doesn't like it, but it makes me feel a lot better when it's a little chilly down here. But we're headed back to the 70s this weekend, so we'll be okay. Now this weekend we were looking over a lot of different research, and we've been reading a lot of stuff from folks like Mark Lazary and Howard Marks and some others about the incredible opportunities in distressed debt in the energy field. Now, when I first started as a broker many years ago, we did quite a bit of distressed security stuff. There was nobody really doing it. There were no big funds, no tens of billions of dollars chasing the same few assets. Everybody armed with 30 lawyers and 14 accountants. It's hard for me to have an edge in that type of thing, except when there's because special situations going on. So back then, I mean, the utility preferred stocks with the arrearages because of nuclear overruns, Texas-related real estate bust-ups. It was just so much fun. But for the most part, by the late 1990s, we'd gotten away from that because it was too competitive. The market is an ecosystem. If you find attractive returns, too much money is going to come in and make that return go away in many cases. One of the reasons we love the community banks, it's just not possible. The big money can't get in there, leaving us a playing field to ourselves and a few other select participants. That changed, of course, in 2002 with the internet bust, and there were tons of bonds around. One that really sticks in my brain all the time is the Amazon convertibles that were trading off 30 cents on the dollar, and the ration was that they'd never made money, they were never going to make money, they were going to go bust. Well, Amazon did anything but go bust, and we more than doubled our money in a relatively short period of time, and there were dozens of those. We had tremendous years in 2003, 2004 in distressed securities, but then as markets normalized, we got back to the thing where we were just too small. There was not enough opportunity for a single player with not tens of billions and lots of attorneys to play. So we pulled back away from it. So I was curious. I went onto the Trace bond site and I looked at all the energy bonds, and wow, kid in a candy store time, folks. There's just a ton of paper out there in companies that I think are going to make it. And they're, the ratings agencies do too at this point. They're rated B and double B. They're senior and senior secured bonds, and 10, 15, and even a little bit higher yields to maturity on these things, depending how far out the maturity scale you go. Awful lot of these companies are going to make it unless oil goes to zero. I don't think oil's going to zero now. Having said that, I didn't think it was going below 30 either, but here we are. But I think eventually oil prices do turn. I think there's some money to be made for experienced guys with, you've got to have a high tolerance for risk, you've got to have a very long time frame, and you have to have a better than novice knowledge of accounting and laws and things like that. But having said that, if you qualify, you really should be drifting over to the NASDAQ Trace bond information site and taking a look at some of the incredible bargains. You can get into what I think are really safe companies going to be around for a really long time with 11 and 12% yields right now. If you go a little bit further out the risk curve, you're getting 15 plus. So these bonds are trading 40, 50, 60 cents on the dollar. Oil bounces back up to 50, and these companies go from, I'm not sure they're going to make it, to, yeah, okay, business isn't great, but they're going to make it. Those bonds are going to leap ahead in price, leading to some relatively fast gains. So if you feel like you have the experience and the knowledge, you should be drifting over, because the energy debt, distressed debt, is really starting to look like a once-in-a-lifetime opportunity. We have, by the way, we're watching the oil markets. We're aware that they are down quite a bit again today. We've picked our double down spot. We get closer to it every day, down another few percent today in crude oil futures. But we'll double down before too much longer if this carnage in crude continues. Now, the bright spot is we also saw the FDIC quarterly report today, and skipping right ahead to the community bank section, 7.5% earnings growth on average. Lower loan loss provisions. That's good news because credit's improving, but we'd like to see the lower loan loss provisions kind of start to go back the other way. I'm right there with Chris Marinac of FIG Partners. I think banks should be taking a more prudent approach and adding just a little bit to reserves here. Credit's as good as it can possibly get. We are in the absolute sweet spot of the credit cycle, and you might see non-performing loans start to tick back up. So maybe we need to put some reserves back in the system. Hopefully it goes that way over the next couple quarters. 60% of banks had higher year-over-year earnings. Just 5.2% of all community banks, those with $10 billion in assets or less, according to the FDIC, were unprofitable in the fourth quarter of 2015. So things are really good in the banking sector right now. 71% grew their loan book, and across the board, pretty much everybody reported increased lending activity to the small business community. That's actually a great sign for the future direction of the economy. We're definitely stuck right now in that better but not good economy, but if small business picks up, they can drive the economy forward over time. So that was another very positive sign. We dodged a bullet today. I came in until the little magic China report came out and made everything better. I kind of thought we'd have a big sell-off this morning. At Friday's close, I made up a list of stocks that were close, and I was ready to load up this morning. Did not get my chance. We bought a couple small REITs last week. We added a bonus bank to the portfolio. That's one of those banks that's too small to put into the portfolio. Nice little bank trading at 85% of book with some activist involvement. But we didn't get to do any widespread investing today. We're just not there yet. Let me give you a sense of the numbers here, okay? The S&P 500 is down 12%, a little less than 12% actually, off the all-time highs. Looks much worse when you get to the Russell 2000. We're down about 23% off the all-time highs. However, what I found when I really just started digging in there, those are all pretty much, there's a lot of low-quality companies in there, a lot of commodity and energy-related companies. We know we own some of them, exactly how bad that has been over the past year. But when we really went looking for the high-quality, deep-value stocks that a Walter Schloss stock picker might put in their portfolio, very limited selection. Let me give you an idea of how limited. Looked at a database today of 5,444 domestic listed stocks, okay? We ran two simple fundamental credit checks. Piotrowski F-score of 6 or better, indicating fundamentals were good and getting better, and an Altman Z-score of 3 or more, indicating that the company was not likely to experience any financial distress. Now this sets aside financials, but I'll come back to those in just a moment. So 718 passed those, just two quick and dirty credit tests. Now, 27 of those traded for less than tangible book value. Those that we do not already own, there was another reason, something we didn't like about the business that would make us discard them and not include them in the portfolio. So if it's there and it's safe and it's cheap, we own it, and hopefully we'll get good returns from it this year. Very limited. We have not yet seen the type of sell-off that's going to create a lot of opportunities. Now, if we just go over to banks, there's 58 banks that trade below book value with an equity to assets ratio of 10 or more. Now, when we dig those down and we look for those with the low non-performing loans that we like and have an activist investor, I think our buy list was 24, 25 names in the banking on profits portfolio this past week. I will say there's about 10 more. We buy up to 92% of book value in that portfolio. There's probably about another 10 names that wouldn't take too much selling to push down into the buy list. We'd like to see that buy list expand a little bit. We had an 18% year last year, 18.07% gain in banking on profits for 2015. We think we're going to do even better than that in 2016 as the pace of M&A activity and continued fundamental improvements in the community bank space continue to drive those stocks higher. Now, look, it's a time for caution, okay? Yes, markets are much more volatile, but let's keep in mind, for all this bouncing around, you're over 20 times earnings in the S&P and the Russell 2000 right now, so they're volatile. That doesn't mean they're cheap, and as we've seen, there's certainly not a lot of them that are safe and cheap. So 50% cash in the main deep value portfolio, about 45% in the international deep value portfolio. If we can find it, we'll buy it. So far, we're not finding it. A couple little REITs last week, little bonus bank, not a lot of new names to add to the portfolio. Hopefully, we're going to get there. We've got some stocks we want to double down on. We've identified exactly where we want to do that. And if we can get a little more downward pressure in here, we're going to step in. We want to spend the cash. We want to get to a market that has that extraordinary opportunity that Charlie Munger likes to talk about. But just looking at a couple of things around the web today. I looked at Medfavor's timing model. The only thing on a buy model was government bonds. Everything else was a sell. Looked at the GMO markets forecast model, 7-year forecast. The only thing with much above zero, I think U.S. small caps were like 0 point something per year for the next 7 years. Emerging market debts and equity, he expects about GMO expects about a 4% average annual return there. No interest. Timber, about a 4.5% return. Not really interested in a 4.5% return in timber, so we'll pass on those as well. It's a time for caution, so we have a lot of cash. Yes, markets volatility has certainly picked up. Markets are absolutely going in the direction we want to see them go so we can deploy our cash. But much as I used to always have to tell my kids when we were taking that nice long drive from Annapolis down to Ocean City, Maryland when they were kids, no, we're not there yet. Okay, we may get there. We're getting closer. We're starting to see some things that look like they might slip into being really exciting opportunities really soon, but we have to wait for them to get there. As we all know, my record of predicting what the market might do is horrific. So we're not going to jump in and buy a bunch of stocks because we think that we're going to hit a floor here. We're going to wait them to come to our very precise levels. It's worked for us continually in the past. In the aftermath of the 87 crash, the 1998, I don't forget what that sell-off, long-term capital and currency moves created an Asian crisis that led to a nice collapse in markets. Certainly in 2002 and 2003 it worked very well, and in 2008, 2009 it was spectacular in the aftermath of that. We'll get there. Until then, we can ride cash and community banks. Remember, if you had done, kind of the mix I talked about last year, using about 70% community banks, about 30% deep value, you ended up beating the market. If you focused entirely on community banks, you slaughtered the market, and some guys did do that. So community banks, some special situations and opportunities, lots of cash. That's still our mantra so far in 2016. We'd like to see that continue, that market to continue to decline, to create a significant, magnificent opportunity. But no, we're not there yet. Headed that way, it looks like, though. Anyway, I've got to go walk the dog out here. It's going to be below 50 degrees, very chilly, so I think to cheer myself up, what I'll do is I'll call my daughter while I walk the dog and ask how things are there in Chicago. Anyway, this is Tim Melvin, the Tim Melvin Deep Value Report and the Banking on Profit newsletter coming to you from down here in chilly Central Florida, where hopefully it's going to warm up over the next couple of days. Thanks, guys. See you next week.